Hey y'all, Trevor here with Reverb Financial. In today's video, we want to talk about bear markets, what causes them, and how does this apply to you and your money. Let's jump into it. Let's start with a simple definition of a bear market. What is it? Simply put, you need to follow the rule of 20%. If there is a 20% loss from the peak high of a major index like the Dow Jones Industrial Average or the S&P 500, that constitutes a bear market. Now, if we were to track the market since 1928, we would see historically that there's been 27 bear markets, including this one we're experiencing here in 2022. But let's split up that time frame just a little bit. What was it like before World War II? And what was it like after World War II? Well, before World War II, from 1928 to 1945, there were 12 bear markets, or about one every year and a half. Now, after World War II, we have seen 15 bear markets, and that's about one bear market every 5 years. So how does that compare to a bull market? Well, the average bear market from 1928 until now lasts about 9 months and loses about 35% of its value. The average bull market, on the other hand, lasts just over 2.7 years and gains 114%. So what causes a bear market? If we were to evaluate the last 27 bear markets almost over the course of the last 100 years, it generally boils down to a slowing down of the economy. People are spending less money, they're holding on to more of their dollar bills, and therefore companies aren't earning as high of a profit and valuations start to decrease. But that's not always the case. Sometimes a bear market can be pandemic related, such as we saw in 2020, or it can be the result of a market bubble bursting, as we saw in the early 2000s, the dot-com crash. Maybe it is war related, or geopolitical events or crises around the world, or such as in the 1970s when the federal government intervened to help slow down inflation, just like we're seeing today. A lot of things can cause bear markets, but typically it is a slowing down of an economy. Now that we've defined what a bear market is and what are potential causes of them, let's talk about this year. As of the recording of this video at the end of the third quarter 2022, the S&P 500 is down just over 24%, the Dow Jones Industrial Average is down just over 20%, and the NASDAQ is down just over 32%. So this year we've seen a transition from a bull market early on into a market correction, which is a loss of 10% or more. And now we've entered a bear market stage, which is a loss of 20% or more. So what has caused this year's bear market? Well, it pretty much boils down to two very large events that have not just affected the US economy, but that has affected the global market as a whole. The first event is the war in Ukraine. The entire world was shocked, and the markets were shocked as well when on February 20th, Russia invaded Ukraine. Not only did the markets respond with some short-term panic and some sell-off, but the entire West responded as well with a completely different foreign policy toward Russia. European countries and the US issued sanctions against Russia and their oil. And so that caused a massive oil supply lack in our country as well as the European countries. And when the price of oil increases, not only does that affect our trip to the gas station, we all experienced the pain of that earlier this year, but it affects basically every market sector. When the price of energy increases, the price of goods and services increase. And when the prices of goods and services increase, this causes inflation, which leads into the second main event that happened this year, inflation and the fight against it. As much as we'd love to forget that 2020 ever existed, we need to step back in time and talk about COVID for a second. Not only did COVID leave a lasting, permanent effect on our families and on our health, but it left a lingering effect on our markets as well. When the entire world shut down and we were all quarantined, the government's response to kickstart the economy back to life was to push trillions of dollars into it, as well as lower the rate. And it worked. But here's the problem. This $trillion-plus lifesaver was thrown into the economy with extreme supply shortages. So all of a sudden people have more money, they want to spend more, but there's not the supply to spend it on. We all saw the effect of this. We saw this in the used car market. New cars weren't being made, so used cars just went through the roof. We saw the same in real estate. New homes couldn't be made, so all of the other homes rose 30 or 40%. More money equals more spending equals more demand plus less supply equals, you guessed it, inflation. And this is when the government stepped in, just as they stepped in the 1970s when inflation was a problem then too. Now, the Federal Reserve basically has one job, and that's to preserve the value of our currency. So when inflation steps in, that is a huge threat to the value of the currency. And how do they preserve the value? They can raise the interest rate. So back in 2020, they dropped the rate, which further pushed tons of money into the economy. And then when they raise the rate, that takes money out of the economy and hurts market valuations. So how bad is inflation right now? Well, the June report for inflation read that year over year we were at 9%, which is the highest inflation has ever been since 1981. The August report that we received earlier this month showed that inflation year over year had reduced to 8.2%. However, this is still higher than what the Feds had expected, and during their meeting this month they raised rates yet again, causing more selling in the markets and pushing this year's market into bear territory. So when can we expect things to start getting better? Though we do not carry a magic 8-ball to predict future market valuations, there are a couple things that we should be looking at. First of all, we need to be watching for the stability of fixed income. When classes that are supposed to be safe, like fixed income, are volatile, riskier classes like stocks will be volatile as well. When fixed income becomes healthier, we can expect to see some healthier outcomes in the market as well. Number two, watch the Fed hikes. The Feds have continued to express that they are committed to raising interest rates, planning at least another 125 basis points or 1.25% by the end of the year, even willing to put the country into a recession during the process. These rate hikes have had tremendous effect on market valuations, home values, increased mortgage rates. When we see a slowdown on these hikes, we will likely see more stability in the market as well. And number three, watch inflation. As inflation reports continue to decrease, this can definitely serve as a positive sign for where the market is headed. So what should I do? Number one, reevaluate where your emergency savings are. Because of the higher interest rates, that means there are better money market accounts out there that may yield much higher rates than you're getting in your savings account right now. You can go to bankrate.com. This isn't an endorsement, or you can go to any number of websites to see where you might get the highest yields for your savings account. And savings accounts are safe. Number two, stay invested. Schwab released this really neat report that shows earnings for 2020 and what it would have looked like if you sold and missed out on the top 10, 20, 30, and 40 best market days of the year. This demonstrates the importance of staying invested during hard times. If you leave the market now, you've locked in your losses. I'd also add that when you stay invested, now is probably not the best time to make a massive portfolio model shift from aggressive to conservative. Why is that? Well, it's very similar to locking in your losses when you leave the market. When you switch your portfolio model from aggressive to conservative and the market swings back to a bull, you will have missed out on the gains to bring your portfolio back up to the top. Number three, keep investing. For people just starting to invest, this is actually a very exciting time. Stocks are on a discount from their all-time high. If you have a 401k or Roth IRA, keep investing monthly into it. Now, by investing monthly, you're actually buying in all different cycles of the market. You're diversifying your time into the market, which leads to my last point. If you aren't already, diversify your investments. If you're a client here at Reverb, all of your managed assets are already diversified. You don't need to worry about that. But if you aren't a client and you'd like some advice, we'd love to be a sounding board for you. Hey, we get it. Times like these can be concerning. If you have any concerns about the market, or if you're looking to seek out some financial advice, we'd be happy to help. Just head over to reverbfinancial.com, hit contact us, reach out. We'd be happy to connect.